Technology is essential because of the scale of the issue. Money launderers use sophisticated criminal techniques to enter the financial system. Those techniques need to be countered by equally advanced technology. And the criminals will always try and find the weakest point of entry into a financial institution. They're very fluid, very nimble, very adaptive. And banks and their controls, and particularly their technology, needs to adapt. So, for example, an AML technology will look for patterns of behavior and alerts a compliance department to suspicious transactions. It may be the way that payments are structured, the frequency of those payments, the destination, the originator, the beneficiary. There are many, many variables. Secondly, the process of screening customers or transactions for particular risks has become much more advanced. The regulatory requirements are more sophisticated. A few years ago, it was a relatively straightforward process, although one of some scale. But the regulator would publish a list, the institution took the list, screened it against its customers and transactions. Today, it's become more complex because it may not only be the person that's the subject of the sanction. It may be their business partners, their counterparties, companies in which that individual holds a share. And working out who owns what's subject to AML considerations can be very complex. And the only way of managing that in a time-efficient way and in a way that's going to satisfy regulatory expectations is to use powerful technology. An example I have is that in the aftermath of some prominent collapses or financial scandals, there may have been a feeling that these risks weren't detected quickly enough. And one of the very early warning indicators could be the media, whether traditional media, print, newspapers, newswires, or even social media. Very often these media are the first source to break a story. And the quicker that a financial institution can pick up on negative trends, accusations, or even formal charges, the quicker it can then respond to protect itself and its customers. We're seeing more use of analytics to correlate news information to risks. We're seeing more use of analytics to create a single view of a customer. So, for example, instead of having risk profiles siloed away in different lines of businesses for different products in different geographies, our customers are increasingly bringing these profiles all together and using technology to connect all the dots between them so that their compliance officers can have a holistic view of the client's risk from every dimension. And that's really important because it means they can respond more quickly to a threat. There's no one-size-fits-all approach to an effective risk management program for regulatory matters such as anti-money laundering or counter-terrorism financing. And I think regulators are very aware of this. A few years ago, when regulators were visiting their institutions, the questions used to be along the lines of, do you have an AML program? Today, the questions are a lot more sophisticated. It's, how often do you refresh your program? Who did the risk assessment? Under what methodology? How often is that risk assessment refreshed? What technology do you use? Why did you choose that technology? Again, how did you make sure it fitted your risk profile? How often do you check the configurations? How do you make sure it's tuned to provide effective protection against the risks that are evolving on a daily basis? So these are the types of measures that regulators now expect. And that means that the technology piece really needs to be more thoroughly understood. I think one of the worst things an institution could do is put in a black box off the shelf on default configurations and expect that system to be appropriate for that institution's particular risk profile. It could be the case that it is, but there needs to be a more thorough understanding of the technology's capabilities and, importantly, of the customer's own risks. The financial system is very innovative, and innovations such as mobile payment technologies have really been transformational, particularly in emerging markets or developing markets where previously large sections of the population who were previously unbanked in a traditional sense can now participate in the financial system. It's a very flexible and adaptable technology. Providers of these services very often don't have a significant legacy technology base. The technology is quick to deploy and it's very nimble. Now that provides some really compelling competitive advantages. What we see is that these new technologies, these new methods of payments, peer-to-peer for example, mobile payments stored valued, they're increasingly becoming regulated and brought into the mainstream of the regulatory compliance framework. I think that's a good thing. It's not to add an additional layer of bureaucracy or to level the playing field. I know there's been a perception perhaps that because certain types of activities were less regulated that they had some competitive advantages. But there is a need to ensure that terrorists aren't appropriating these technologies for their own ends. So we're seeing greater interest in making sure that innovation continues, that these services continue to be available to the people who really need them, particularly in poorer countries, but that there are controls and protections as well, so the criminals and terrorists misuse them for their own needs.